January 25, 2026. A Thursday that quietly changed financial history. For the first time ever, silver crossed $129 an ounce. And something even more important happened. It did not crash back down. While most people were focused on AI stocks and tech rallies, a deeper shift was happening in the global financial system. If you bought $10,000 of physical silver last year, it would now be worth about $33,600. Gold is moving close to $5,000 an ounce. And the gold to silver ratio has dropped to levels last seen in 2011. Yet mainstream financial media barely mentioned it. This is not about luck. This is not about timing the market. This is about long-term forces that serious analysts have been watching for years. And now those forces can no longer be ignored. The real question is not what happened last week. The real question is what comes next. Welcome to Currency Fictions. If you've spent years building something real, if you understand that wealth is not just made, but protected, if you remember when financial advice came from experience, not algorithms, then you're in the right place. If this matters to you, consider subscribing, not for numbers, but because these conversations matter for anyone thinking about their family's future. And tell us, where are you watching from today? Drop your location in the comments. Let's see how global this conversation really is. Now, let's talk about what just happened to silver. On January 23, 2026. Silver crossed a level no analyst alive had ever seen. It moved above $129 per ounce, confirmed by multiple independent sources. This was not a glitch, not a short squeeze, not social media hype. Silver held its ground. 2 days later, it was still trading above $100. That matters. In past rallies, prices spiked and collapsed quickly. This time, silver stabilized. That tells experienced investors one thing. This is not speculation. This is a revaluation. Someone who invested $10,000 in physical silver in January 2025 is now up over 230%. Not in a trading account, not in digital assets, but in real metal, stored safely, outside the banking system. At the same time, gold pushed toward $5,000. Bringing the gold to silver ratio down to about 50 to 1. Historically, this ratio usually sits between 60 and 80. When it drops this low, it signals strong demand for silver based on real use, not hype. Silver is different. It is money, and it is essential for industry. Solar panels, electric vehicles, 5G infrastructure, all require silver, and mine supply is not keeping up. Meanwhile, global silver stockpiles are shrinking, and yet, financial media remains mostly silent. They still talk about stocks. They still talk about digital assets. They still say precious metals are outdated. But behind the scenes, long-term investors have been preparing for this moment for years. And now, that moment has arrived. Most investors were busy chasing stock and cryptocurrency momentum. But a smaller group understood something important, something the wider market is only now starting to see. When paper prices move too far away from physical reality, when derivative markets stop reflecting real supply, and when money loses value faster than official numbers admit, the correction does not happen slowly. It happens all at once. Moments like January 23, 2026. And once that shift begins, it does not reverse just because prices move. It grows stronger. The same problems that pushed silver to $129 are still here today, even at $113. So the real question is not whether this move made sense. The real question is whether this was the beginning, or just the first chapter. There is a silver mine in Peru that explains what is really happening. The Cerro de Pasco mine sits high in the Andes. It has produced silver for more than 400 years. But in 2024, the company that owns it made a quiet announcement. The silver that can be mined with today's technology is almost gone. Geologists had known this for years. The financial media barely noticed. And this is not just one mine. According to the US Geological Survey, Global silver production peaked in 2016. Since then, output has fallen by about 2% every year. Not because miners stopped trying, but because the easy silver has already been mined. What remains is deeper underground, harder to reach, more expensive to produce. At the same time, demand for silver has changed. In 1990, only about 1/3 of silver was used for industry. By 2020, it was more than half. By 2025, nearly 2/3 of all silver demand came from industrial use. That change matters. In the past, people could delay buying silver jewelry. Investors could wait. Demand could fall during slow economies. Industrial demand does not work that way. Solar panels cannot be made without silver. There is no replacement that works the same way. Electric vehicles need silver for wiring and charging systems. There is no workaround. 5G networks require silver in critical components. The technology depends on it. This demand is built into the system. It does not rise and fall with moods or markets. Now look at the numbers. In 2026, solar manufacturing alone is expected to use over 3,200 tons of silver. Electric vehicles will consume another 1,400 tons. Electronics, medical devices, water purification, and batteries add even more. Total industrial demand is expected to exceed 17,500 tons. But total global mine production is only about 24,500 tons, and falling. Once you include investment demand and jewelry, total usage goes far beyond supply. The result is a yearly shortfall of roughly 5,000 to 7,000 tons. For years, that gap was filled by stored silver, metal held in vaults, warehouses, and reserves. Those stockpiles are now shrinking fast. And there is one more risk serious analysts watch closely. Supply is concentrated in just a few countries. Mexico produces about 23% of the world's silver. Peru produces 18%. China produces 13%. 3 countries control more than half of global supply. Any political shift, any export restriction, any national policy change, and the shortage becomes much worse, very quickly. This is not theory. In late 2025, Mexico's new government announced a review of mining concessions. And that was just the beginning. The government called it national resource sovereignty. Most financial news barely mentioned it. But large manufacturers noticed right away. They started increasing their physical silver inventories, not paper contracts, real metal. At the same time, something serious was happening in the futures market. On the COMEX exchange, where silver prices are supposed to reflect supply and demand, the system had become badly unbalanced. For every 1 ounce of real silver available for delivery, there were about 250 ounces of paper claims. 250 to 1. That setup works when markets are calm. Most contracts are settled with cash. Very few people ask for physical delivery. But that changes when demand shifts. When factories need real metal. When investors move away from ETFs and want stored silver. When physical supply actually matters. That is when the system shows its weakness. January 23rd was not just a price move. It was the moment when paper promises no longer matched reality. And that gap is not closing. It is growing. There is a family office in Zurich that saw this coming early. In 2019, they made a decision that seemed strange at the time. They moved 18% of their liquid wealth into physical silver, about $47 million, not in banks, stored in private vaults across 3 continents. They were not trying to trade silver. They were not chasing short-term gains. Their thinking was simple. Every paper currency system in history eventually resets against real assets. And when that happens, physical metal protects wealth in ways paper assets cannot. That $47 million is now worth about $157 million. But here is the key point. They have not sold a single ounce. Because this was never about making a quick profit. It was about preparing for what comes next. That difference matters. The real question is not whether silver performed well last year. The numbers already prove that. The real question is whether your current setup still makes sense going forward. To answer that, You have to understand risk differently than most investors are taught. Take silver ETFs, for example. They are easy to buy, easy to sell. They show up neatly in your account. But they come with risks most people never look at. The silver is held by custodians, stored in warehouses you do not control, and under certain conditions, the ETF can settle in cash instead of metal. In normal times, this works fine. But precious metals are not meant for normal times. They are meant for stress, for system shocks, for moments when rules change, when banks freeze, when capital controls appear, when access to assets is restricted. In those moments, the difference between owning a silver symbol on a screen and owning physical metal becomes very real. It is the difference between numbers on paper and actual purchasing power. And that is not fear. That is history. We have seen this before. In Cyprus in 2013, people woke up to frozen bank accounts. Their savings were used to rescue the banking system. In Greece in 2015, cash withdrawals were limited to $60 a day. In Lebanon in 2019, banks simply stopped allowing people to withdraw foreign currency. In every one of these cases, the pattern was the same. People who held paper claims faced limits, forced conversions, or losses. People who held physical precious metals in private storage kept their purchasing power. That brings us to the real strategic question: how much of a portfolio should be in physical metals today? There is no single answer. It depends on risk tolerance and time horizon. For conservative wealth protection, large institutions usually suggest 5 to 10% in physical metals, mostly gold, with some silver. For those who believe financial risks are higher today, 15 to 25% becomes reasonable, with more weight toward silver due to tight supply. For those who believe we are entering a major currency reset, similar to the 1970s, allocations above 30% entered the discussion. At that point, the goal shifts from diversification to conviction. But allocation is only part of the decision. The form matters just as much. Physical coins and bars, private vault storage, allocated storage in stable countries, or pooled accounts that cost less but carry more risk. Each serves a different purpose. A business owner may want small coins stored in multiple locations for quick access. A retiree may prefer long-term storage in secure vaults. An entrepreneur building generational wealth may split between accessible metal and low-cost storage. The key idea is simple. Precious metals are not a trade. They are insurance. And insurance only works if you have it before the crisis, not after. Now look at what institutions are doing. In 2024, central banks added about 1,370 tons of gold to their reserves. That is one of the largest buying years in over 50 years. China, India, Poland, Singapore, the Czech Republic, very different countries, very different systems, all buying metals at the same time. These are not speculative bets. These are long-term decisions made by institutions responsible for national stability. When central banks buy gold at levels last seen in the 1970s, and silver faces historic supply shortages, the signal is clear. The move that began on January 23 was not the end. It was the beginning of a reset. A reset in how paper money relates to real assets. And those who understand this are positioning early. There is one final question analysts always ask. Is this the end of a cycle, or the start of a structural shift? If this was just a speculative spike, prices will fade in reverse. If it was recognition of real imbalances, then this is only the first phase. The data points to the second scenario. Institutional models now assume continued currency weakening, high government debt, and strong industrial demand driven by energy transition. And that combination changes everything. Let's look at the possible paths ahead. In the bull case, silver continues rising. Supply stays tight. Industrial demand keeps growing. More investors move into physical metal. Under this scenario, silver could reach $200 to $250 per ounce within the next 18 to 24 months. Commodity-focused hedge funds assign this outcome about a 35 to 40% chance. The base case is more moderate. Silver trades in a wide range, roughly $95 to $130 per ounce. Prices move up and down, but stay elevated. Paper markets try to control price moves. Physical premiums stay high. Industrial demand keeps growing, but more slowly. Mine production stabilizes. Central banks remain supportive, but avoid full crisis. This is the most likely outcome, with a probability of 45 to 50%. The bear case requires several major changes at the same time. Central banks would need to raise interest rates sharply and keep them high. That would trigger debt and pension problems. Global demand would need to collapse in a deep recession. New major silver mines would need to appear quickly, or technology would need to replace silver in key industries. The probability of this scenario is less than 15%, not because it is impossible, but because political and economic realities make it very unlikely. Now ask yourself this: what would it take for silver to fall back to $30? Interest rates would need to stay above 6% for years. Governments would need to abandon green energy programs. Solar and electric vehicle policies would need to reverse. Large new silver mines would need to come online quickly, and manufacturers would need to replace silver with alternatives that do not exist today. Each of these is unlikely on its own. All of them happening together is close to impossible. That imbalance is what serious investors focus on. The downside requires many unlikely events. The upside only requires current trends to continue. But probabilities alone are not enough. You must watch the right signals. Here are the key indicators: Federal Reserve policy and real interest rates. If real rates stay negative, metals stay supported. China's accumulation of strategic metals. They often act months before official announcements. COMEX warehouse inventories. When registered silver falls below 50 million ounces, physical stress increases. Solar manufacturing expansion plans. Every 1 gigawatt of new capacity requires about 11 tons of silver each year. Sovereign wealth fund disclosures. Institutional capital moves slowly, but once it moves, it stays. These are not guesses. They are structural signals. Now the practical question: what should business owners and investors actually do? The answer depends on personal risk tolerance. But a few principles apply to everyone. First, own physical metal before considering stocks, ETFs, or derivatives. Physical ownership removes counterparty risk. Second, entry price matters less than many think during major transitions. If silver's destination is much higher, the key is having exposure at all. Third, storage matters as much as buying. Home safes carry personal risk. Bank deposit boxes carry access risk. Private vaults require careful location and reputation checks. The best approach is usually a mix. Some metal close at hand. Some stored securely in stable jurisdictions. Fourth, your strategy should match your life and business. A manufacturer may treat silver as a hedge on raw materials. A service business owner may use it as liquid wealth outside banks. A real estate investor may use it to balance property exposure. Purpose determines structure. And here is the final difference between speculation and positioning. Those who survived the 1970s inflation, the 2008 financial crisis, and the 2020 monetary expansion all had one thing in common. They positioned before the crowd understood the problem, not after. History shows us something important. By the time financial media agrees a trend is real, by the time economists explain it in textbooks, by the time governments admit there is a problem, the opportunity to act is already gone. January 23, 2026 will likely be remembered as the day silver's revaluation became obvious. But for those who understand monetary history, for those who focus on real supply and demand, for those who know that every currency system eventually resets against hard assets, That day was not a surprise, it was confirmation. The signs had been there for years. So the question now is not whether silver's move was justified. The real question is whether this move is finished or whether it has only just begun. And the answer to that question will decide who protects their wealth in the years ahead and who finds out too late that paper promises and digital balances are not the same as assets you can actually hold in your hands.